is fluctuating, it is dynamic. In case of company it remains fixed, but it is only on the financial statement it remains fixed. If the company goes on to liquidation, then surplus is transferred to the shareholder. If company goes to liquidation and there is a loss, then they will lose their equity, because ultimately the business is liable to the business, is liable to the owners, and liable to the third party. The priority is like that. Business is first required to be satisfied liability to the third party. If third party's liabilities are satisfied, then and then only the residual part will be claimed by the equity holders. So it is the basic sum which is provided by owner to the company or a business, and therefore the risk and return is belonging to the owners. The second term, that is liability. Liability is a current obligation of the business. It means at a particular point of time when liability appears on the balance sheet, on that particular date, the business is liable to return that amount to the supplier of liability. So to satisfy that liability or to discharge that liability, some resources are required. It means until and unless resources are sacrificed, liability cannot be satisfied. On other hand, the future liability is not liability of the business. The liability in the present context is the liability of the business. So ultimately, by equity and liability, these are the sources of the business create asset, and they are known as the resources. Resources are owned and controlled by the business. So in strict legal terms, the absolute ownership is not required, but the control is important rather than the ownership. I will give few examples to that. Say for example, if you are having a company working in Israel or Afghanistan or Iraq, if due to political disturbances the assets are not within your control, then that asset will not appear into your balance sheet, because the second part of the asset is resources is not controlled by you, and therefore that part will not be shown on the financial statement. Now these resources are created by certain transaction, and this transaction has been created by liability. It means the self-created asset is not an asset. Self-created liability, self-created asset like goodwill is not recorded. Only goodwill is recorded if the money has been paid. It means until and unless some resources are not sacrificed to that asset, it is not recorded. It means if the goodwill is self-created, it is not shown on the balance sheet. It is only shown if goodwill has been purchased. And other than resources, other than control, other than it should be result of a transaction, it should be useful to the business. If it is not useful to the business, then there is no value to the business, and it will not be shown on the balance sheet of the company. So another term is very much important, that is the profit, that is the surplus of revenue over the expenses, and loss is opposite to that. When revenue is short of the expenses, there is a loss. In US context, which you are referring the book, there are a lot of confusion between terminology, because in India what we term profit is sometimes used in US as an income, but in India income is well defined by the income tax law, and it is inflow of revenue which is defined by law. Sometimes it is real, sometimes it is notional, while in case of profit it is always a real one. Expenses are sacrifice of asset. It means sacrifice of asset does not result into creation of asset. It means if sacrifice of asset result into some other asset, then it is not known as expense, it is known as expenditure. And ultimately equity plus liability is also a liability, and it is known as equities. It is in plural term. Singular equities, liability toward owners, and if there is a total liability of owners and other parties, it is known as equities. So this is the basic balance sheet equation. Assets are always